Hey everyone, welcome to another video. I've just decided that I'm going to do away with fancy slides, fancy introductions, fancy music, just so that it's a whole lot easier to record these videos and get content out. This is an educational channel, so I figured if you're learning something valuable and useful, you probably wouldn't care about all of those extra things. So today I want to talk about Comcast, and I'm excited to also share kind of an investing method using options that I feel like is fairly conservative and can generate fairly steady, decent returns. And I've been using it in my own portfolio for a while now with promising results. So I'd like to share an idea, a trade idea with you. I actually don't like to call them trade ideas. I call them investment ideas because the way that I trade, I guess, is more of a long-term investing way of trading and based on fundamentals of the company with a little bit of a longer view on the underlying company. So today I want to talk about Comcast. So what I have on the screen here is Comcast's most recent presentation from their Q4 end of year report at the end of January. And so this is a nice summary of the company as far as kind of different business segments. You've got the Xfinity business segment, which is their broadband cable business. You've got NBC Universal, which is their media business with NBC, other cable channels. And what's interesting to me, we think of Disneyland and Disney. We don't often think about Comcast having a nice theme park business with Universal Studios, but they have a nice theme park business, and I think that's been a good business for them and will continue to be. So you can kind of see the numbers here by revenue and adjusted EBITDA for each of these business segments. Sky is one that they acquired. It's a big media company in the UK. Probably, I think the biggest or one of the biggest over there in the UK. So you can see full year revenue, full year adjusted EBITDA. This is the number that stands out to me. So 17.1 billion of free cash flow. So this company generates a lot of cash flow. And it's kind of, the cable broadband business is kind of like a utility. It just steadily churns along. All of us are going to need broadband for the foreseeable future, and they supply broadband to millions of households, primarily I think in the US. So if we flip over here to one of my favorite tools, Finbox, I'll try and put a link to Finbox in the description below. But this is it's a paid service. It's not terribly expensive. I think I pay about $20 a month, and it helps you value companies essentially, and provides a bunch of data on companies so you can evaluate them. So you can see here that the fair value that this Finbox service has concluded, looking at 14 different models here and kind of averaging those. They've concluded a fair value of about $64 a share. It's trading at $46 a share today, which means there's 40% upside. And they also have this nice low uncertainty score, low, medium, high, or very high, I think. And this is low, meaning that they're fairly confident in the fair value assessment. Probably because a lot of these models are coming out to be within a tight range, right? Sometimes you get models that are varying widely. So the other thing I want to show you is just, that $17 billion of free cash flow might mean nothing if you don't know how much the entire company is being valued at. So the enterprise value is the price that you would have to pay if you wanted to buy the entire company today. It's the price of all the equity plus all the debt. So that's 301 billion. So the equity is this market cap. So 208 billion is the value of all the shares. But they've also got net debt of 98 billion. So it's kind of like if you own a home, you may have a mortgage on it and still owe some money to creditors. So you don't necessarily own 100% of your home, But if somebody were to buy your home, they'd have to pay the full price of the debt and equity, right? That's enterprise value. So $301 billion, but they're, this last year they generated 17 billion in free cash flow. This number is saying 18, almost 19, but it's just measuring probably a slightly different period. It might have been not including that last quarter and doing 12 months prior to that. But anyways, it's probably around like an 8% free cash flow yield. So what that means for those who aren't super familiar with fundamentals, that's pretty high yield. So that means this company is generating about, if you think about the company like a bond, or just any asset that generates a return, real estate, whatnot. This is returning about, it's not this high anymore. Like I said, 17 billion, so it's like 8% a year return. And so effectively, if you turn that into a multiple, what is that, like 12, 13 times free cash flow, right? So if it didn't grow at all in the future, 12, 13 years from now, it would return, the value of the entire company. But it is growing. You can see, if I click into this revenue, you can kind of see it's grown over time and likely will continue to grow. The nice thing about Finbox, if I can go back here, there are, under earnings, you can see projections of earnings in the futures ahead from analysts, and you can see it's expected to grow earnings, double digits for the next several years. And then you can switch over to revenue, and revenue is going up slower, so single digits, maybe mid-single digits, but it's still growing. So it's not like it's a declining business. But I think it's undervalued. I have some investments in Comcast, and I want to show you one way that you can invest in Comcast. Let me switch over to my Thinkorswim. Using options, and this is a fairly conservative way. If you're familiar with cash secured puts or covered calls, then this method that I'm going to show you, which I'm working on a course right now for it, I like to call it, the method I'm going to show you is similar to cash secured puts or covered calls. I like to call it the Airbnb options trading method, because if you think about Airbnb, a lot of people are getting into Airbnb as investment and buying properties, and so essentially what you do with Airbnb investing is, right, you buy a long duration asset like a home or an apartment or a cabin, and then you rent it out short term to generate cash flow off of it, right? So that's essentially a covered call. So a covered call, you buy 100 shares of stock, and then you can sell call options off of that, essentially rent, right? So every 30 days, you could sell a new option that expires 30 days from now. But if you don't have, or you don't want to invest, you don't want to buy 100 shares of stock, which for Comcast at $46 a share would cost you $4,600. Maybe you don't have $4,600 to drop on Comcast to do a covered call. This is where it's kind of like an Airbnb method, where some people, instead of buying a home, they will lease a home, right, for, let's say, a year or 2 years lease, and then they'll have permission to kind of sublease that on a daily, weekly, monthly basis, right? So it's not an ownership interest, but it's a longer term interest, and then they are generating cash flow off of that by selling even shorter term interests. So what we can do, and this is also known as a poor man's covered call, I guess, or deep in the money poor man's covered call. I just like to call it the Airbnb options trading method. That's how I think about it. So let me go to this. I'm going to analyze this trade here. So I like to sell an option 30 days out, but let's look at the long-term option. So I like to go a year out. So this January 23rd, 2023, or sorry, January 20th, 2023 option here. And I like to go kind of at least an 80 delta. So let's say I buy this 35 call option, and that would cost me about in between the bid and ask, $1,220, so $1,220 for that long duration deep in the money option. And then I am going to sell this 30-day option, expires March 25th, and you get the most time value. So this column here is the amount of extrinsic value. So your extrinsic value is maximized right at the money. So this $46 option's right at the money. I get $1.58 or $158 of time value. So I'm going to add that to this trade down here. It creates a diagonal spread. So, lots of names. Poor man's covered call, diagonal spread. I'm calling it the Airbnb options trade. But this net is going to cost me, $1,067 to put on this trade. But remember, we were buying the long-term option for about $1,200, and now we're selling this short-term option for about $155 to $160. And so the idea is, so no matter what, this time value will always decay, whether the stock goes up, down. Over the next 30 days, that $155 is going to go down to zero of time value, right? Now, it could have intrinsic value that as the stock goes up and it goes into the money, you start to have an element of intrinsic value that's not time value, and so your price of the option could go up. But it's being offset by your long duration $35 long call, right? And so if I look at the risk profile for this trade, this is ignore the pink line. The pink line is showing me the profit loss as of March 4th, and I can change that date. But the blue line is showing me at the first expiration, so of the near-term option expiring March 26th, what does the profit loss look like at different prices, right? So the x-axis down here is different prices. And so let me just adjust this here. So at $46 a share, that's where I'm going to maximize my profit on this trade, right? And these poor man covered call, diagonal spreads, they have this usually, unless you buy really deep, the deeper I go, if I bought, instead of 35, if I bought the 25, you see that downward droop as the price goes up decreases. So I could do that. It would just take more capital put on this trade. So let's say, to go back to the 35, so it's going to droop as the price goes up, right? Oops, what did I do here? Accidentally, there we go. So it's still always positive. So even if it went up to like infinity, I'm still going to make $33. That's because I'm paying less than the width of the spread. So I've got a $11 spread here, and I'm paying $10.67. Anyway, so I always want to at least situate my spread. So I choose the long call that's deep enough in the money so that I'm in a situation where it will always be a positive result no matter how high the stock price goes. And then on the downside, you can see the current price is right here at $46. That's what it's trading at today. Actually break even if the stock drops a little to $44.20, right? So I have like a $1.80 of wiggle room to the downside where I'll still be profitable on this trade. And then beyond that, I just have losses. But the idea is that you want to do this on fairly stable companies, solid companies financially, so hopefully the downside is limited. If we look at the chart of Comcast, it's already down here. It was at $60 not too long ago, and now it's down to levels that, if you look over here on the chart, we were at these levels back in 2020, September 2020, even back to July 2020. So it's been a couple of years since we've actually been down this low. And I feel like this is a solid company. I think there's a lot of solid support at this current area. You can see a lot of price action here in the $45 range. And you can see from this volume at price graph here, there's a lot of volume at the prices that we're at now. So that kind of creates a nice strong floor for it. So I think the risk of downside is limited. We even have some wiggle room, like I said, in that trade to go down to the $44 area and still break even. And so the idea is hopefully we stay around the same or we bounce. And if we do that, we will, going back here, we'll collect the time value that, from the short-term option. That will just decay. That $155 short-term option will decay. And so the max profit's around, this is showing $144. So it's going to be around that $150 range max profit. And then it kind of slowly goes down. So if it were to go to $50, meaning the stock price went up, we'd still make $86. But if you think about it, I mean, whether it's 150 or 86, that's a decent return on the capital risk over a 1 month period, right? So you're generating, at the max, you're generating about a 15% return. If it went up here, and you're making $80 or so, you're still generating like a 7% return, right? And so tell me, where else can you get a 15 or 7% return in 1 month, right? I mean, I think that beats any sort of rental property. It beats Airbnb investing. It pretty much beats any other investing strategy out there over time. Now, of course, you're going to have some times where it goes down and you lose money. So maybe we only make 5% a month on average, right, from these trades. And generally, you can put these on where the max profit's around 10%. This one happens to be more. But if I went deeper in the money because I wanted to flatten that curve, so let's say I did 30, right, I'd be spending $1,500 and still making about $150. So that's about a 10% return. So you can generally make a 10% return if everything goes right. But you've got to think that not every month things are going to go right, and you could have some months where it falls down and you're down a couple $100, and so now you're in the red. But I think over time, if you have a pretty good solid stock and its price is fairly stable, you can generate, it's not unreasonable to generate 5% a month return. You do that month after month, and that's a pretty decent return over a 1 year period, over 12 months, right? So just wanted to share that with you. I've been doing this for a while, and even in this down market, I'm not going to lie, I mean, things are down over the last couple months, but they're not down huge, and it's recoverable. And the nice thing is, once we get to March 26th and this option, the short-term option is expired, we can turn around and sell the April option for another 30 days, maybe for another $150. If it's still trading around $46 a share. If it went up, we could sell a higher priced option. So you can do this every month and effectively collect that monthly rent. So if you want to learn more about this, so that's kind of the basics of this strategy. It goes a lot deeper. I've got mechanisms where we can kind of hedge our downside for not a huge cost, and so you can move, essentially you can move your break even on the downside even further down, so that your losses, even if the stock goes down quite a bit, you're still actually breaking even, right? And there's other strategies. If you kind of have a pretty significant loss, the stock goes down 20% or so, there's strategies with this where you can recover. You can move down your break even and recover, with fairly, I don't want to say easily, but you can move your break even down. So probabilities are that the stock bounces back, you can get back to even fairly quickly. So if you're interested in learning more, just let me know in the comments. If I do have a link, I'm in the process, like I said, of creating a website for a course that I'm building. So maybe if I have that link up, then I'll put it in the description if I don't have it yet and you're interested. you want to just stay in contact, then just comment below. But yeah, I hope that you learned something. I hope that this was interesting. And I hope to do videos like this about other stocks that I'm following that I do this strategy with, so that you can follow along if you're interested in that sort of thing. Anyway, take care. Thanks.